Hey everyone, and thanks for jumping back into the equityverse. Today, we're going to talk about the S&P 500, and we're going to be comparing it to bear markets of the past. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. We do have several different tiers available as always, including a free one. Links in the description below. Let's go ahead and jump in. So I thought it would be worthwhile to provide an update to this video series that we've done for probably about a year now or so, where we just look at the bear market, but also within the context of prior bear markets. Not to tell us what has to happen, because this bear market has taken its own path and it will continue to take its own path, but just to show you what can happen and therefore to be prepared for for all scenarios. So that's what we're going to take a look at today, looking at sort of the soft landing case versus the hard landing case. This is something that, of course, is being discussed quite frequently across various platforms. So, of course, when you just look at it like this, it's hard to really make heads or tails as to what's actually going on. So what we're going to do is we're going to pull up the current bear market. Now, this is the 2022 bear market, potentially also the 2022 to 2023 bear market. We don't really have confirmation yet that the bear market has extended into 2023. Of course, you might have your bias as to what you think is going to happen, but until it actually goes and puts in a lower low, or say like a double bottom or something, it's hard to really make the case that it has extended into 2023 just yet. But upon a future lower low, if we get one, then of course the bear market will have lasted into 2023. Right now, of course, a lot of people are excited because we sort of put in a low over here just a few months ago, and now we're moving up again and putting in a higher high. So there is at least something different there that is worthwhile to talk about, and of course we'll talk about it. But the first thing I want to do is I want to go through and look at prior bear markets and just sort of compare where we are within the context of those. So, of course, there's the 2020 bear market, which is pretty much useless to compare to, just because we went straight down and the Fed printed our way out, and now we have all these inflation issues. But if you take a look at the financial crisis, we were sort of following that one for a while, but here you can see a pretty clear deviation from the analog of the financial crisis. So that one has certainly detoured away. Now, if you go take a look at the dot-com crash, hasn't really detoured away just yet. And in fact, after about 421 days into the dot-com crash, we were actually around a similar level in terms of drawdown from the all-time high. So this one is one that I think is going to continue to be worthwhile to follow. And I'm not suggesting that this bear market has to last all the way out until the dot-com crash did. I think, if you look at what was actually going on back then, the recession for the dot-com crash actually occurred here. And this sort of leg down over here, I believe, was probably more tied to the events of 2001 rather than the recession that we actually hit, because the recession was here, and that's where the S&P hit this major bottom, and it could have been the low, right? Like, it could have been the final low, but then of course we had the events of September 2001 unfold, and the stock market ended up going lower. So I would say if you're looking at this one, it's probably worthwhile to sort of look at it on this scale. And then if we do make it there, then to maybe consider this. But I'm certainly not going in with my base case as it having to last this long. But this is, of course, one that we can continue to watch, because after a very similar amount of time, the drawdown from the all-time high is pretty close to what we've previously seen. Additionally, it's also interesting as well because in this one over here, you also had a phase where you put in sort of like a higher low, and then this was more or less like a triple top. So something different from this one, but it does show there are changes in the structure of the bear market. It doesn't necessarily mean the bear market's over, but it could be going into a different phase of the bear market. See, this over here was fairly structural and fairly fairly nice in terms of just sort of like drawing the downtrend lines, but now we've sort of deviated out of that. And so I think we've entered into potentially another phase of it, right? I mean, whether that means we go and put a new low or we just spend a while carving out a new range, of course, is up for interpretation. But I also want to take a look at the bear market from 73 to 74, and the one after World War II that took place from 1946 to 1949. So let's first start with the one after World War II. This is what I would say would be representative of a soft landing. So there's always been this discussion of, well, can the Fed achieve a soft landing, or is it going to be a hard landing? This is what I think a soft landing might look like, where rather than going in and putting in a major leg lower where the S&P goes to, like, say 2500 or something, it just sort of scrapes along the lows for a number of years, right? So like it would correspond essentially, and again, the blue line is what this line here is the current bear market, and this sort of dashed line is the one from 1946 to 1949. So this would sort of correspond to just chopping around this range for, a couple more years or something, which I know would be quite brutal. But if the Fed achieves what they say, and that's higher for longer, that means we should not expect rate cuts until likely 2024. Now, the market is saying we're going to get a rate cut at the end of the 2023. But even if you think about, let's say a year from now, you're talking almost another 400 days, just below 400 days. That's going to get you all the way out, somewhere over here in terms of length of the bear market, if the Fed continues to sort of hike. Now, of course, there's these arguments that we're in this sort of transitionary period where the economy. I've made this argument before, where inflation hasn't reaccelerated yet, but we are getting some CPI data next week. But then also the job market, the labor market still remains relatively tight, so we haven't really seen the deterioration of that. And so the market is sort of hesitating in both directions, right? Like, it doesn't really want to commit to the upside. It doesn't also really want to commit to the downside. But this is what I would argue what a soft landing would look like, where, maybe you come back down and you go and put in a slightly lower low, or maybe another bottom at the same place we went to last time. And then a lot of people might think, all right, well, now we're going to make another leg lower, only for us to just bounce right back up again. And then for everyone to get excited that that's the bull market, only for us to come back down and then finally put in our last low. This is what I would consider to be a soft landing. Note that if the soft landing takes place, we certainly don't have to see it take place over this entire time frame. Like, it doesn't have to last 1,100 days. But, I mean, this stuff does show you that bear markets can last that long. It's not like they're immune to lasting that long. It's just something to consider. But I like to show this chart because I think, there's a lot of people out there that when you think about the bearish scenario, you only think about, and I struggle with this myself sometimes, if I'm being honest, right? You only think about, all right, well, the next leg lower, where is it going to end up? The soft landing scenario would more so suggest, all right, we might scrape the lows for a couple years, but people who get super bearish, they might not see those prices that they really want. Of course, some people might say, well, what's the argument for that? I suppose if there's just simply enough money in circulation, even with the Fed raising interest rates, they might not be able to really drain as much money out as they want. Now, that's one consideration. That's sort of the soft landing consideration. The hard landing consideration is something that looks like the 1973 to 1974 bear market, which was also during a period of high inflation. So you have the 46 to 49, which was period of high inflation. You also have 73 to 74, period of high inflation. And note that they all came, and let me actually just isolate just the 2022 bear market and the one from 73 to 74. So if we were to follow the one from 73 to 74, I would argue that would be a hard landing. So what it would correspond to would essentially just be slowly moving back down, and maybe, in about 3 or 4 months from now, so maybe this summer, capitulating to our final bottom is what something like that would look like if we're going to play out similar to the 73 to 74 bear market, and if we're going to see a hard landing. The way that we could get there, right, if you think that's impossible, so in the same way that the soft landing might seem unlikely to someone who's super bearish, if you're really bullish, you might wonder, well, how could this possibly play out? Well, I think that the way that you could see this potentially play out is the Federal Reserve remaining too hawkish for too long. Okay, this is, if you look at the context of history, one of the main reasons we go into recessions is because the Fed pushes us there, right? Like they remain too hawkish for too long. Now, arguably, they know that they're doing that, and they understand that a recession would actually help out with inflation, and it does seem that that's a risk they're prepared to take because they'd rather crush inflation than worry too much about whether we head into a recession or not. But I suppose that would be more the bearish outlook on the S&P 500 is like we haven't even really gotten to a year after the first rate hike. So what happens by this summer when now we're really starting to feel the rate hikes from, the 75 basis point rate hikes from a year ago? And if we have some type of credit event, then you might not see that structural bear market or a soft landing. It could be something like what we saw in 73 to 74, or it could be something like we saw during the financial crisis, just delayed for a bit longer. So what's interesting though is if you overlay the 73, 74 bear market with the current one and the one from 46 to 49, which again was also a period during high inflation, this is what you get. And what's interesting about all three of them is they're all more or less around the same level at around the same time. Now, right now, we are higher than those two bear markets as a function of time. But if you note, after 423 days into those bear markets, you can see that both of these other two bear markets were down, a very similar amount, like maybe 22.5% or so from the all-time high. Of course, this one right now is not actually no, not 22.5, maybe about 17.5% from the all-time high. Whereas, because if you look at this, like going down 10%, we sort of touch that right here. 20% is something that the S&P did do during this bear market, but here, it'd be somewhere in between, right? You're talking about somewhere between 15, 20% down, maybe somewhere in the middle is where these other two bear markets ended up getting, say, like another short-term peak here. But what's interesting is they deviated. So the one from 46 to 49 continued on this way, but the 73 to 74 had a hard landing. So if you're trying to conceptualize, like the difference between a soft landing and a hard landing, I think this is one way you do it. You just simply look at two cases. One was a hard landing, one was a soft landing. And one, the market, the S&P 500 went down a lot. I mean, this one went down almost 50% from the all-time high. Even the financial crisis, right? If you look at the financial crisis right here, this one went down, more than 50% from the all-time high. Pretty brutal. So this sort of distinguishes between a hard landing and a soft landing. Now, there's other bear markets we could compare to, right? You have the 68 to 70 bear market. And that one's interesting because, if you actually look at where it is right now, it's actually just on top of where that bear market was. So, if, the people that experienced the 68 to 1970 bear market as a function of time, it's currently at the same level. Now, the way that we got there was very different, but you can see how that one ultimately resolved. It ultimately resolved at around 540 days or so, which would be about 6 months from now. So these are things that I think we need to be aware of, especially as we continue on to 2023. And it still remains to be seen if the bear market is over or not. I do think we need to of course, be prepared for a scenario where we come back down and maybe retest some of those lows at the very least and try to identify, is it a soft landing or is it not? I do think some people are likely getting a bit ahead of themselves and just simply unilaterally declaring the bear market over just because we put in a higher low. If you look at prior bear markets, you can see that does not always mean the end. I mean, just take a look at the one we're looking at right now, like the one from 68 to 70. I mean, this one's sort of like a low and then a high and then a lower low, and then it put in a higher high. And even over here, right, a low, a high, and then a lower low, or a higher low, and then a higher high. That doesn't necessarily mean anything, right? Like, I mean, I think we all like to think that it has to mean something. It doesn't necessarily have to mean anything just because you put in a higher level, a higher price. So it's something surely to follow when you look at the 2022 to 2023 bear market. But I still think we all need to have an open mind on what's likely going to happen. I mean, my guess is that the upside is going to be somewhat limited. I mean, could the S&P push higher from here? Sure, right? I mean, could it hit 4,300 or something? Maybe 44. It's possible, but until you see the resolution of of things like the yield curve, and you see some major change in sort of the macro outlook, it's hard for me to envision, the S&P just rallying on up to say 6,000 or something, and I have a hard time seeing that under these conditions, and we'll see what happens. But one thing I thought that's also worthwhile to look at is this sort of maps out the minimum and maximum levels of prior bear markets, assuming they were still a bear market. So it no longer incorporates this range once those prior bear markets cease to be bear markets and they're in the recovery phase. Of course, you don't know if this is the recovery phase until 6 months from now or 12 months from now, when you can look back at it and say, all right, we've been recovering, or we just continue to go on down. But the point of showing this is that as a function of time, there have been prior bear markets that had a drawdown from the all-time high, at least one that was a little bit better than where we are now, and the bear market still continued for a while. Okay, so I don't actually remember which one it was. It might have been, I think it was maybe one of the 60s. So here's one. This is the one we looked at earlier, 68 to 70 bear market. You can kind of see that is sort of near the top of that one. Yeah, so here's the 1980 to 1982 bear market, which was also sort of right around these levels. And in this case, it would have continued to chop around, maybe come down and put in a slightly higher low from what we did last year. And then sometime later in 1980, it actually put in maybe a slightly lower low compared to sort of where it was. So this was a low. This was a slightly lower low, I guess, not a double bottom. And then one more lower low later on. And then was it the no, it wasn't that one. Yeah, so it was the 56 to 57. So the 56 to 57 bear market was the one that sort of came back up and then ultimately fell back down. So again, I mean, within the context of history, bear markets take all sorts of shapes. Now, if you go look at this chart over here, again, I mean, we are above this trend line, which is something that was always going to happen eventually, and we talked about this, right? You have a rejection here, you have a rejection here, and then a rejection, and another rejection. Eventually, we're going to break through this, and then it's going to sort of enter into a different phase of the bear market, whether it's the end of it or we just go into another phase like we did in the dot-com crash, where we had sort of a head fake, and then it just went down into its final low. But what I'd be looking for at the very least, I suppose, is at some point, coming back down and sort of retesting this trend line and seeing if that can hold. And if that can hold and we can continue higher, then I think you have a better case. But if we just sort of, pop up and then come back down here and then, just sort of fall back in, then it just sort of becomes this thing where, okay, well, maybe the bear market's just going to continue on for a while, and perhaps the inversion of the yield curve is evidence of that. I think a lot of people have sort of dismissed some of these indicators like the inversion of the yield curve and that sort of stuff as things that no longer matter. But imagine, imagine if we do get a recession eventually. And these indicators were screaming it all along. I mean, if you've watched my channel for the last year, you'll know that I don't really think we've been in a recession. I mean, I know people would point towards 2 negative quarters of GDP, but when you have a labor market at 3.5 or 3.4% unemployment, and I mean, there's still various sectors of the economy that seem like they're doing quite well. It's hard, I think, especially in 2022. I think it's very hard to make the case that we were in a recession, other than the fact that we had 2 consecutive quarters of negative GDP. But in terms of the labor market, that's normally the lagging indicator. It's the last thing to really turn up, but it's likely going to take that happening before a recession would be declared. So again, I'm in the camp that we haven't been in a recession, but that one could easily come either later this year or early 2024, right? So we'll see. I mean, right now this bear market, recently it's gotten people somewhat excited because we've broken through the trend line. Still think we're going to have a lot of work to do this year. And another way to potentially look at this, by the way, is to just sort of say we've been range bound, since April of 2022. You could argue that there's just been some level of being range bound, and perhaps another way to think about it is looking at it like this and saying that we've been in this range right here, since April of 2022, we had a deviation to the upside. We had a deviation to the downside, but we more or less stay in this range. So if we just are simply getting rejected here at the 4,200 level, then I think the area to watch would be what happens when we come back down, or if and when we come back down to see that 36 to 3,700. Do we just sort of bounce in this range for a while? This would, I think, be more akin to what a soft landing would look like, where you're able to bounce around in this range. The likelihood that the S&P just rallies on up and goes crazy and puts in, a massive gain to, 5 or 6,000, I think is unlikely at this phase. But if you're just maybe a slightly more bullish comment, but I shouldn't get ahead of myself, but I'm actually not of the opinion. I know some people are of the opinion that it's going to take like 15 years for us to put in new all-time highs. I don't actually think that's the case. I don't think that it's going to take that long. I think the S&P can probably put in new highs, within a few years. Even by 2024, 2025 timeframe. 2024 might be pushing it, but I don't think you're going to have to wait until 2035 to see new all-time highs. Now, one of the reasons people might point to this taking 15 years is they might look at something like this and say, well, this basically took, 13 years, if you don't include this little double top here that maybe slightly went higher. But I feel like that's cherry picking, or even if you look at the NASDAQ, right? Like to say that it took, from 2000 to 2016, I would say that to some level that's cherry picking, because you have so much data to look at for the S&P 500, and in many cases, and in most cases, it did not take 10, 15 years. If you look at periods of high inflation, which might be more useful to compare to, like the 1970s, or even say 1966 to 1968, right, a new high. And then 1968 to 1973, a new high. And then from 73, we put in a new high here. It was 7 years later. But again, it wasn't 15 years. And then from 1980, which again was coming out of a period of high inflation, to putting in, and some of these were, just started going from high to high, not just breaking a new high. But from this high to breaking into a new high, it was from 1980 to 1982 or 1983 or so. So, and you could also even look at, say, like the 1940s. History shows us that it doesn't tend to take 10 to 15 years to put in new highs. You, of course, are free to cherry pick this example here as sort of a reason. And even then, we at least came back up to the highs about 7 years later before crashing back down. And then if you just ignore this one, and you look at this peak here going into the financial crisis, this was from 2007, we were putting in new highs about 5 years later. This high occurred in 2021. So, 4 years, it would put us in, 2025. 5 years would put us in 2026. I think something like that is more likely than suggesting it's going to take out until 2035 is my honest opinion. So I know some people get on me because I've been pretty bearish over the last 14, 15 months or so, but I'm not really of the opinion that it's going to take that long. I think that it'll be time to really get bullish on risk assets, and maybe later this year is what I would guess. But for now, I think we're going to still be carving out some type of a macro bottom, trying to figure out if it's a soft landing or if we get a credit event and it ends up being a hard landing. I think you should be prepared for either scenario. And of course, I can't tell you exactly what's going to happen because unfortunately, I do not have a crystal ball. I think we're going to wrap it up there. If you guys like the content, make sure you subscribe, give the video a thumbs up. Also, we do have Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.